All right, let's get right into it. Have you ever wondered how a stock trading app like Robinhood or Zerodha actually works under the hood? Especially when the market goes crazy and millions of people are trying to trade at once? Well, today we're going to break down the system design for a massive stock trading platform inspired by a real-world technical interview.
So let's just start with the scale of the problem. How in the world do you build an application that can handle 10 billion requests in a single day? I mean, that's the kind of insane traffic we're designing for. It's a huge challenge.
So, what are we actually building here? Our core task is to create the stockbroker application itself. This is the platform that users, actually see and interact with on their phones.
And let's be super clear about our scope. We are designing the application layer that sits in the middle, connecting users to the market. We are not building the stock exchange itself, like the New York Stock Exchange. That whole complex system that matches buyers and sellers is an external service we just need to talk to.
Okay, before we start drawing any diagrams or talking about servers, we need a solid blueprint. We have to define exactly what this system needs to do. Those are the functional requirements, and figure out just how much traffic it needs to handle.
So, functionally, what are the absolute must-haves? Well, first, users have to be able to place buy and sell orders. That's a given. We also need to support both market orders, which just execute at whatever the current price is, and limit orders, where you set a specific price. And of course, the big one. Users need to see those stock prices updating live in real time. Now this right here, this is the core tension of the entire design. Our system really has two different jobs, and they have conflicting priorities. When it comes to trading, the actual buying and selling, consistency is everything. An order can never be lost. It is better for the service to go down for a minute than to make a mistake with someone's money. But for viewing prices, availability is king. The price feed has to be up. It's okay if it's a couple of seconds out of date, but it can't go down. This trade-off is going to shape our whole architecture.
So just how big are we talking? Well, we're designing for a platform with 100 million total registered users.
But total users isn't the whole story. The real pressure comes from the daily active users. We're expecting 10 million people, a full 10% of our user base, to be on the app every single day. And this number is just wild. At peak times, just the part of the system for viewing prices needs to handle 20,000 requests every single second. Think about that. That's an absolutely massive, read-heavy workload that we have to solve for.
All right, so let's tackle that challenge head-on. First up, we're going to design the system that's responsible for broadcasting those live stock prices to millions of users at the same time. This is all about speed and uptime.
So how do we actually get those live price updates from our servers to your phone? We've basically got two main technologies to choose from: WebSockets and Server-Sent Events, or SSE. Think of it like this. WebSockets are a two-way street, perfect for something like a chat app where you're sending and receiving messages constantly. But SSE is a one-way highway. The server just pushes updates to the client, which is exactly what we need here.
And the source material we're looking at really sums it up perfectly. It says, WebSocket might be an overkill. This doesn't look like a two-way communication. Exactly. The client is just listening. It doesn't need to talk back. So using WebSockets would be like using a sledgehammer to crock a nut. SSE is the more efficient, purpose-built tool for this job. So let's trace the journey of a single price update. It all starts at the stock exchange itself. It pushes price ticks to our exchange gateway. This gateway then does two things at once. It stores the data in a database so we can draw historical charts, and it passes the live tick over to our price service. That service then immediately pushes the update out to the user's app using SSE. It's a really clean and direct data pipeline.
Now for storage, we're not using just any old database. We're using a specific type called a time series database, or TSD. These are specially designed to handle data that's stamped with a time, like stock prices. This makes them incredibly fast for queries like, hey, show me the price of Apple stock for the last hour.
Okay, so we've got the price feed humming along. Now let's switch gears to the most critical, high-stakes part of our system, the engine that actually processes the buy and sell orders. This is where money is on the line, and we absolutely cannot afford any mistakes.
At the very heart of this trading engine is our order database. Now, if we look at the structure, you see the usual suspects, like an ID for our system and the user's ID. But the most important field here is the exchange order ID. When we first get an order, this field is empty. But once the actual stock exchange accepts our order, they give us their official ID and we store it right here.
This is our proof, our unbreakable link to the real-world transaction.
Now here's a really critical architectural decision. When a user hits buy, we don't just immediately try to send that request to the stock exchange. That would be way too risky. Instead, we use a decoupled asynchronous flow. The user's request hits our order service, which immediately saves it to our database with a pending status. Then, and this is the key, it drops the order into a message queue like Kafka. A completely separate service, our exchange gateway, just sits there, pulls orders from the queue, and then sends them off to the exchange. This separation is what makes the whole system so incredibly resilient.
And this is exactly why we do it that way. What happens if the network connection to the exchange flickers for a second? Well, if we were sending the request directly, that order might just vanish into thin air. But with our design, no problem. The order is sitting safely in the Kafka queue. The gateway will just try sending it again. And if, for some reason, it keeps failing, it gets moved to a special dead letter queue for a human to investigate. The bottom line is, an order is never, ever lost.
Okay, so we've got our two core systems designed, the super fast price feed and the bulletproof trading engine. Now, how do we make sure this entire setup doesn't just collapse when the market goes wild and millions of users flood the app all at once?
Well, it comes down to a few really clever strategies. First, co-location. We physically put our servers in the same data center as the stock exchange. This cuts network latency down from milliseconds to microseconds. It's a huge deal. For internal communication between our own services, we use super fast tools like Redis Pub Sub. We also shard our database by user ID, which basically means all of one user's data lives in one place, making it faster to get to. For our biggest clients, like hedge funds, we have dedicated servers already warmed up and waiting for them. And finally, that Kafka queue we keep mentioning, it also acts as a shock absorber, letting us control the rate of orders so we never overwhelm the exchange. It's all about speed and control.
So there you have it, a high-level blueprint for a stock trading platform built for massive scale. You can really see it's a tale of two systems, one designed for blazing speed and availability, and the other for absolute, rock-solid consistency. But of course, no design is perfect, so I'll leave you with this to think about. Looking at this whole architecture, what do you think is its single biggest point of failure? Where would it be most likely to break?